Welcome to what might be the most contrarian take on Bittensor subnet tokens you'll hear this year. While everyone else is drinking the AI crypto Kool-Aid, I'm here to ask the uncomfortable questions that nobody wants to address. I've spent months analyzing subnet tokenomics, diving into the actual usage data, and what I've found is concerning. The gap between the narrative and reality is wider than the Grand Canyon, and retail investors are getting caught in the middle. Today, we're going to dissect the fundamental flaws in subnet token valuation, expose the circular reasoning that props up current prices, and discuss why most of these tokens might be heading for a harsh reality check. This isn't food for the sake of FUD. This is honest analysis based on data, not hopium. And yes, I'll still reference that unsupervised capital piece in the description, because even though I disagree with some of their conclusions, their data is solid. Everyone loves to compare subnet tokens to Bitcoin, but this comparison reveals why subnet tokens are actually inferior as investments. Bitcoin succeeded because it's simple, predictable, and doesn't depend on complex business or operations to maintain its value. Bitcoin's value proposition is clear: digital scarcity with network effects. You don't need to evaluate management teams, business models, or competitive landscapes. It either works as digital money or it doesn't. 17 years in, and it's working. Subnet tokens, on the other hand, are business ventures masquerading as currency investments. Each token represents a bet on a specific AI network's ability to capture market share, maintain technical competitiveness, avoid regulatory issues, and generate sustainable revenue. That's a lot of variables that can go wrong. The tokenomics comparison makes this even clearer. Bitcoin's supply schedule is mathematically guaranteed and requires no human intervention. Subnet token emissions depend on subjective validator assessments, changing network parameters, and governance decisions that can be influenced by whale token holders. Here's the uncomfortable truth: most subnet networks don't actually need their tokens to function. The AI services could be provided just as effectively with traditional payment systems. The tokens exist primarily to create investment vehicles and speculation opportunities, not because they solve real technical problems. Bitcoin's proof-of-work mechanism creates real, measurable security. Subnet tokens rely on proof-of-stake systems that concentrate power among large token holders and create circular value propositions where token price affects network security, which affects token value, a feedback loop ripe for manipulation. Let's address the elephant in the room. All these sophisticated valuation models for subnet tokens are built on fundamentally flawed assumptions. They're like elaborate mathematical models for predicting lottery numbers. Impressive looking, but ultimately meaningless. The network value to transactions ratio sounds scientific, but it's garbage in, garbage out. Most subnet transactions are validators talking to each other, not real economic activity. It's like measuring a restaurant's success by counting how many times the kitchen staff talks to each other, not how many customers actually eat there. The total addressable market approach assumes subnet networks will capture meaningful market share from established AI companies. But why would businesses switch from reliable, regulated services like OpenAI or Google Cloud AI to experimental crypto networks with unclear legal status and untested reliability? Discounted cash flow models for subnet tokens are particularly absurd. They require predicting cash flows for networks that currently generate minimal real revenue, operating in an industry that changes every 6 months, using tokens whose value affects the cash flows you're trying to predict. It's financial modeling inception. The cost of replication argument falls apart when you realize that most subnet functionality could be replicated by any competent AI team in a few months. The barriers to entry aren't the technology. They're regulatory compliance, customer trust, and distribution channels that crypto networks explicitly avoid. Metcalfe's law application to subnet networks is mathematically dishonest. Network effects in AI services are nowhere near as strong as in social networks or communication protocols. If a subnet becomes expensive or unreliable, users can switch to alternatives with minimal switching costs. The honest valuation model for most subnet tokens is pure speculation. Price hype X, Hulmaum plus APY stone reality. Currently, hype is very high, APY is artificially inflated, and reality is approaching fast. Let's talk about the massive red flag everyone's ignoring: the unsustainable APY rates being offered by subnet tokens. When you see 50-100% annual yields, your first question should be, who's paying for this? And the answer is usually future token buyers. Most subnet APY comes from inflationary token emissions, not network revenue. This is textbook Ponzi economics. Early participants are paid with money from later participants. The network prints tokens to pay current stakers, diluting everyone's holdings while creating the illusion of profit. The few subnets that claim revenue-based yields rarely provide transparent accounting. Where are the audited financial statements? Who are the paying customers? How sustainable are these revenue streams? The answers are usually vague references to network activity and ecosystem growth. High APY rates create perverse incentives that actually harm network development. Teams focus on maintaining token prices and yields rather than building useful AI services. Why spend time on boring things like customer acquisition when you can just adjust emission parameters to keep stakers happy? The yield farming crowd doesn't care about subnet fundamentals. They're just chasing the highest APY, ready to dump tokens the moment yields drop or better opportunities emerge. This creates extreme price volatility that makes the tokens unsuitable for their supposed use cases. Even worse, high APY requirements mean these networks need exponential user growth just to maintain current token prices. That's not a business model. It's a growth hack that works until it doesn't. The current subnet token market exhibits every classic bubble characteristic. Unrealistic valuations, widespread speculation by uninformed participants, and a narrative that this time is different. Spoiler alert, it's not different. Subnet tokens with zero revenue are trading at market caps that would make profitable tech companies blush. We are seeing valuations that assume these experimental networks will not only succeed, but dominate their respective AI market segments. The hubris is staggering. The most telling sign is how disconnected prices are from actual network usage. I've analyzed networks with thousands of dollars in weekly revenue trading tokens worth millions. The math doesn't math, as the kids say. Retail investors are buying subnet tokens without understanding the underlying technology, competitive landscape, or business models. They're investing based on YouTube videos and Twitter threads, not due diligence. This is 2017 ICO mania all over again. The whale concentration in most subnet tokens is extreme. A few large holders can manipulate prices easily, creating fake breakouts and pump and dump schemes. Small investors are playing a game where they don't know the rules and the house always wins. Regulatory risk is massive and largely ignored. Securities regulators are already scrutinizing crypto networks that promise returns based on others' efforts. Most subnet tokens clearly meet the Howey test definition of securities, but they're operating in regulatory gray areas that could disappear overnight. The technical risks are equally concerning. These networks are experimental software running on experimental consensus mechanisms. Code bugs, security vulnerabilities, and network failures could wipe out token values instantly. Here's my prediction. Most subnet tokens will lose 80-90% of their current value within the next 2 years. The ones that survive will be the few that actually build sustainable businesses with real customers and revenue. The bubble will pop when either regulation arrives, a major subnet network fails catastrophically, or simply when the yield farming money moves to the next shiny object. When the music stops, there won't be enough chairs for everyone. My advice, if you own subnet tokens, have an exit strategy and stick to it. Don't let sunken cost fallacy keep you holding worthless tokens. If you're thinking about buying, ask yourself, would you invest in this business if there was no token involved? The AI revolution is real, but it's being built by companies with actual revenue models, not crypto networks sustained by inflation and speculation. Invest accordingly. Check out that Unsupervised Capital article for more data-driven analysis, even if you disagree with their conclusions. Always do your own research, especially when everyone else is telling you not to. Thanks for watching this uncomfortable dose of reality. Sometimes the market needs a skeptic.